Why do most traders watch their perfect analysis crumble into painful losses even when they're absolutely right about where the market is headed? This isn't a question about intelligence or market knowledge. It's about something far more fundamental that separates consistent winners from everyone else. And it has everything to do with understanding one simple truth. The market moves in waves, and your entry point within that wave determines everything. Think about the last time you entered a position with complete confidence. You'd done your homework, the setup looked perfect, and every indicator pointed in your favor. Then what happened? The market immediately moved against you. You watched your position bleed, testing your conviction with every tick downward. The stress mounted, the doubt crept in, and eventually you got stopped out, only to watch in complete agony as the market reversed and went exactly where you predicted. Has this ever happened to you? If it has, you're not alone, and more importantly, you're about to discover why this keeps happening. Here's the uncomfortable reality nobody talks about. Being right about market direction is completely worthless if your timing within the wave structure is wrong. You can have flawless analysis, understand the fundamentals better than anyone in the room, and still lose money consistently. Why? Because you're entering at the wrong phase of the market's natural rhythm. Every significant market move unfolds in waves, a predictable pattern of impulse and correction, surge and pullback, expansion and contraction. When you jump into the impulse phase too early before the correction completes, you're guaranteeing yourself maximum exposure to the very retracements that shake out weak hands. The market doesn't reward speed. It doesn't reward being first. It rewards patience and precision in reading where you are within the current wave cycle. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Now here's what most traders fundamentally misunderstand about market waves. They see price rising and assume they need to get in immediately, or they'll miss the entire move. They fear being left behind while others profit, so they chase the initial surge, entering right as the impulse wave reaches its peak, just before the inevitable pullback begins. What they don't realize is that every healthy market move breathes. It surges forward and then pulls back to consolidate, creating the very opportunity they thought they were missing by waiting. The professional trader sees this completely differently. They understand that the pullback isn't something to fear, it's the gift the market gives you. It's your second chance, your optimal entry point. The moment when the weak hands have been shaken out and a new impulse wave is preparing to launch. Stay with me until the end, because what you're about to discover will completely transform how you read market waves, and why waiting for the pullback isn't missing the opportunity. It's positioning yourself for the highest probability entry with the least amount of psychological torture. The secret isn't about predicting what happens next. It's about recognizing where you are right now, within the wave structure, and having the discipline to wait for the wave to come back to you. Now, I want to go even deeper into this, because understanding wave structure at a fundamental level creates a complete transformation in how you make every trading decision. Most people approach markets with linear thinking. They see price at point A and assume it's going to travel directly to point B in a straight line. But that's not how financial markets actually behave. They move in rhythmic patterns, surging forward with momentum, then retracing to gather strength for the next impulse. It's a natural breathing pattern that plays out across every time frame, every instrument, every market condition. When you recognize this hidden truth about market behavior, everything changes. The trader who chases the initial surge, jumping in during the euphoric phase of the impulse wave, is essentially volunteering to experience maximum psychological pain. They're buying at the point of greatest extension, right before exhaustion sets in and the natural pullback begins. Then they endure every tick of that correction, watching their unrealized profits evaporate or their positions slip into the red. Their conviction gets tested mercilessly. Meanwhile, the trader who patiently waits for that same correction to complete enters at a moment of strength, not weakness. They position themselves at the re-entry point after weak hands have been shaken out, after the wave has consolidated and built a foundation for the next move upward. This isn't about prediction or having some magical ability to see the future. It's about observation and respect for the market's natural rhythm. Here's where the real mindset shift occurs, the revelation that changes your entire journey. You are not a commander of these waves. You cannot force them to behave according to your timeline or your analysis. You are a student, an observer of patterns that existed long before you, arrived, and will continue long after you're gone. The market moves in its own time, with its own rhythm of expansion and contraction, impulse and correction. When you try to impose your will onto this structure, when you force your way into a position during the wrong phase of the wave cycle simply because you believe it should work, you're not demonstrating confidence, you're displaying arrogance, and the market has a very specific, very expensive way of humbling that arrogance. And if you haven't subscribed yet, hit that button now. Everything here is built to give you real principles that actually work, and I don't want you to miss what's coming next. The impact of this realization goes far beyond just avoiding bad entries. It reshapes your entire relationship with risk, timing, and decision-making. If this is starting to click for you, write in the comments, "I respect the wave." Think about this for a moment. Imagine you're standing beside a powerful river. The current surges forward with tremendous force, carrying thousands of gallons of water downstream, then pulls back slightly before the next surge builds momentum again. You're watching this natural rhythm unfold before your eyes. Now, would you try to jump onto a boat that's already speeding away from you at full velocity? Of course not. You'd wait for the current to bring the boat back toward the shore during the pullback, position yourself strategically, and step aboard when the timing is right. This is exactly how market waves function, and yet most traders completely ignore this simple wisdom. You cannot create momentum through analysis or force of will. You cannot make the wave happen faster by entering earlier. The market moves according to its own internal dynamics, driven by millions of participants and billions of dollars, flowing in rhythmic patterns that existed long before you opened your trading account. Your only intelligent choice is to position yourself to ride the next impulse. Wave after the correction phase completes and brings that opportunity back within reach. Attempting to jump into a wave during its parabolic extension phase when momentum is stretched to extremes is the equivalent of trying to board that speeding boat. You'll either miss entirely or get hurt in the process. The pullback is your friend. It's the wave temporarily retreating toward you, creating the perfect entry point with the least resistance and maximum potential for the next surge forward. But here's something that changes the entire game. A hidden truth that separates those who consistently profit from those who struggle endlessly. Before you even think about analyzing an individual stock's wave pattern, you must understand the wave structure of the broader market itself. This is where most people get their entire approach backwards. They find a stock they love, convince themselves it's going to make a beautiful wave pattern upward, and completely ignore the fact that the ocean around that stock is pulling everything downward with relentless force. The macro wave dictates the microwave. Always. If the general market is in a corrective phase, rolling over and building downward momentum, Even the strongest individual stocks will struggle to maintain their upward impulses. They might fight against the tide temporarily, but eventually that broader wave structure asserts its dominance and pulls everything down with it. This is the revelation that protects your capital and saves you from fighting battles you cannot win. You're not just trading a single instrument in isolation. You're navigating within a larger ecosystem where the dominant force sets the tone for everything beneath it. When you trade against that dominant wave, when you try to ride a small upward ripple while the entire ocean is moving in the opposite direction, you're not demonstrating conviction. You're ignoring reality, and that ignorance shows up very clearly in your results. If this perspective is shifting how you see market structure, drop in the comments, macro before micro. This brings us to something fascinating that happens behind the scenes in every trading session. When the overall market is generating a strong impulse wave upward, something almost magical occurs. Even mediocre stocks with questionable fundamentals get lifted higher on that rising tide. The broader momentum is so powerful that it carries almost everything along with it. Weak companies that probably don't deserve to rally suddenly find themselves pushed upward simply because the ocean beneath them is surging. Conversely, when the market enters its corrective phase and that downward wave begins building momentum, even the strongest stocks with perfect earnings and flawless business models get pulled back down. It doesn't matter how good they are individually, the dominant force is moving against them. Understanding this relationship between macro waves and individual stock waves is what prevents you from making the most costly mistake possible, entering at the exact moment when both wave structures are working against you simultaneously. Imagine trying to paddle a canoe upstream while the river itself is also in retreat. You're fighting two opposing forces at once, and that's a battle you simply cannot win. Yet traders do this every single day, finding a stock they believe in and jumping in without checking whether the broader market wave is even moving in a supportive direction. The impact of this oversight compounds rapidly. Not only are you entering at the wrong phase of the individual wave, but you're doing so while the entire environment around that position is hostile to your thesis. Now here's where the discipline that separates professionals from amateurs becomes crystal clear. Even when you've correctly identified that the broader market wave is supportive, even when you've found an individual stock with strong wave structure potential, you still cannot just jump in the moment you notice the setup forming. You must wait for explicit confirmation that a new impulse wave has actually begun after the pullback completes. Not a hint, not a suggestion, not a feeling in your gut that tells you the bottom is probably in. Explicit, undeniable confirmation through actual price action unfolding before your eyes. This means watching the correction find its natural support level, seeing consolidation take place as the wave pauses to gather strength, and then observing the first clear signs of renewed momentum pushing upward with conviction. Trying to catch the exact bottom of a pullback, attempting to enter at the precise low tick of the correction is not trading. It's speculation, gambling on hope rather than reacting to evidence. The transformation in your results happens when you stop trying to be a hero and start being a follower of confirmed waves. If you're finally seeing why confirmation matters more than prediction, write in the comments. Evidence over anticipation. This is where everything we've discussed converges into one practical revelation that you can apply immediately. The ticker tape is speaking to you constantly, every single second of every trading session. It's not hiding information or playing games. It's revealing the current wave structure through actual price action unfolding in real time. When price is pulling back, retracing from recent highs and forming lower highs, the tape is explicitly telling you that the correction wave is in progress. This isn't speculation or interpretation, it's observation of what's actually happening right now. When price begins establishing higher lows, breaking through resistance levels with conviction and building momentum steadily upward, the tape is showing you that the impulse wave is resuming. The evidence is right there in front of you. Here's the mindset shift that transforms everything. You must trust what the wave structure is showing you in this moment, not what you think should happen according to your carefully constructed analysis. Your thesis about where price will eventually go might be completely correct, but if the tape is telling you that the correction isn't finished yet, that the pullback still has more room to run before support is established, you wait. No arguments, no negotiations, no convincing yourself that you know better than the collective voice of millions of participants moving billions of dollars. The tape is the ultimate authority on current wave structure, and when you fight against what it's revealing, you're choosing ego over evidence. But there's another situation that catches even experienced traders off guard, and it's costing them far more than they realize. Sometimes the market enters a state where there simply is no clear wave structure forming at all. Price becomes choppy, erratic, bouncing up and down without any discernible pattern or purpose. One moment, it looks like an impulse wave is building. The next moment, that momentum evaporates and price reverses direction. This isn't a pullback within a healthy wave structure. This is equilibrium, a state where neither bulls nor bears have established control. The buying pressure and selling pressure are perfectly balanced, creating what I call the washing machine effect. It just churns back and forth, shaking out anyone who tries to find a pattern where none exists. During these periods, there's no impulse wave to ride. There's no clear pullback to wait for. There's just noise, randomness, and conditions that punish anyone who insists on being active. The hidden truth that separates consistent winners from everyone else is recognizing when no tradable wave is present and having the discipline to step aside completely until clarity returns. If this is resonating with you, put in the comments, clarity over activity. That recognition of when not to trade brings us to something that's probably costing you more money than any bad trade you've ever taken. It's this overwhelming sensation that grips you the moment you spot an impulse wave beginning to build. You see the momentum starting, volume increasing, price breaking higher, and suddenly there's this voice screaming inside your head telling you that if you don't get in right now, this very second, you're going to miss the entire move. Everyone else is going to profit, and you'll be left behind watching from the sidelines. This fear is visceral, urgent, almost unbearable, and the amateur trader surrenders to it every single time. They rush into the position during that initial surge, convinced they're capturing opportunity, but what they're actually doing is guaranteeing themselves exposure to the inevitable correction that follows every impulse wave. They're volunteering to endure maximum psychological torture. Every tick of the pullback feels personal, every retracement triggers doubt, and by the time the correction reaches its low point and finds support, they've already been stopped out. Then comes the truly painful part. They watch from the sidelines as the stock consolidates at that support level and launches into the next impulse wave, going exactly where they predicted. Except now, they're not in the position anymore. This cycle repeats itself over and over, creating compounding psychological damage that goes far beyond the financial loss. Now here's what's happening behind the scenes that most retail traders never realize. Institutional players, market makers, the professionals who move significant capital, they understand this psychology intimately. They know you're impatient. They know you fear missing out. They know you'll chase the initial impulse wave because you can't tolerate sitting on the sidelines. So they deliberately engineer sharp pullbacks after those initial surges, specifically to exploit this weakness. These corrections are natural parts of healthy wave structure, yes, but they're also weaponized against those who entered too early. The pullback isn't just a random retracement, it's a carefully designed shakeout that targets stop losses, triggers panic, and transfers shares from weak hands to strong hands at optimal prices. This is the hidden mechanism behind the wealth transfer that occurs every single day in the markets. Money flows from the impatient to the patient, from those who chase impulses to those who wait for pullbacks to complete. When you understand this reality, when you truly internalize what's happening beneath the surface, your entire approach transforms. You stop seeing pullbacks as threats and start seeing them as gifts. You stop fearing that you'll miss the move and start recognizing that the real move begins after the shakeout completes. If you're understanding how this game really works, write in the comments, "Patience is my edge." That edge you develop through patience manifests in how you actually execute your entries. The professional trader operates with a completely different philosophy than the amateur. They willingly sacrifice the first portion of the impulse wave, those initial points that everyone else is desperately chasing, to gain something far more valuable: certainty. They're not trying to be heroes who nail the absolute bottom tick of the correction. They're not attempting to prove how smart they are by catching the exact moment the wave turns. They're waiting for proof that the pullback has genuinely finished and a new impulse. Wave is beginning to build momentum. What does that proof look like in practice? It's price establishing higher lows, showing that buying pressure is overwhelming selling pressure at progressively higher levels. It's resistance being broken with conviction, not just tested and rejected. It's sustained momentum that persists across multiple sessions, demonstrating that this isn't just a temporary bounce, but a legitimate wave structure forming. The amateur looks at this approach and thinks the professional is missing opportunity by not entering at the very beginning. But here's the reality behind those missed first few points. The professional captures the bulk of the next impulse wave with dramatically less stress, less capital risk, and far greater confidence. They're not enduring the psychological torture of wondering whether the correction is truly finished. They're not getting shaken out by one final dip that tests their conviction. They're entering with confirmation, riding clean momentum, and sleeping peacefully while their position works in their favor. Now let me show you something that transforms how you read charts and identify these optimal entry points. Every significant wave doesn't just happen randomly out of nowhere. There are specific observable pivot points where waves change direction. These are the battlegrounds where accumulated buying pressure overwhelms selling pressure or vice versa. Support levels where corrections find their floor and reverse. Resistance levels where impulses break through barriers and establish new territory. These aren't arbitrary lines someone drew to look intelligent. They're real zones where the market makes its most important decisions about direction, where wave structure transitions from correction to impulse or impulse to correction. But here's the critical distinction that separates those who profit from those who get trapped. You cannot jump in the instant price approaches one of these pivot points. That's still premature entry dressed up in slightly more sophisticated clothing. You must allow the wave structure to confirm itself through action, not anticipation. Price needs to break through the level with conviction, hold that new territory for multiple sessions, and establish it as solid ground for the next impulse wave to launch from. If you're seeing how confirmation changes everything, write in the comments, "Proof before position." That requirement for proof extends beyond just price action alone. There's another dimension to wave confirmation that most traders completely overlook, and it's what separates genuine momentum from temporary noise: time. A price move that surges dramatically for 1 hour, creating excitement and drawing attention, is not a confirmed wave. It's noise. It could be algorithmic activity, a news headline creating temporary volatility, or institutional players executing large orders for their own purposes. Whatever it is, it's not something you should risk. your capital on because it hasn't proven anything yet, but a move that persists for multiple days, establishing higher lows session after session in an uptrend or lower highs consistently in a downtrend. That's not noise anymore. That's a confirmed impulse wave forming right before your eyes. Time acts as the ultimate filter in your decision-making process, separating false starts from genuine momentum. The longer a wave structure persists and builds on itself without breaking down, the more firmly it's established in the collective psychology of all market participants. The more reliable it becomes as a foundation for committing serious capital. This changes everything about how you evaluate opportunities. You're not hunting for the quickest move that might evaporate tomorrow. You're hunting for the most confirmed, most sustainable, most inevitable wave structure that's already proven itself through both price and time. Think about what that really means for your entire trading journey. The vast majority of successful wave trading isn't about the moments when you're actively in positions. It's about all the time you spend watching without participating. Observing impulse waves surge forward, watching corrections pull back to support, seeing consolidations form and evolve without risking a single dollar of your capital. This is discipline manifesting as strategic advantage. You're waiting for that perfect moment when all the elements align, when a pullback completes its natural cycle, when support is definitively established, and when the next impulse wave is just beginning to gather momentum with confirmation from both price and time. Here's a revelation that completely transforms how you think about your capital. Cash is a position. It's not something you hold reluctantly when you can't find a trade. It's often the most strategically advantageous position you can take, especially when wave structures are unclear or incomplete. Being in cash keeps you completely safe from unclear market conditions, while keeping you ready and able to strike with full conviction when that perfect setup finally materializes. If this is reshaping your perspective, write in the comments, "Waiting is my strategy." The hidden truth playing out in every successful trader's journey is this simple but profound reality. The market continuously transfers wealth from those who chase impulse waves to those who patiently wait for the optimal entry point after each healthy correction completes. That transfer happens quietly, consistently, every single trading day. And now you understand the mechanism behind it. You understand why the pullback isn't something to fear, but something to embrace. You understand why waiting feels uncomfortable, but generates the most reliable results. This knowledge alone puts you ahead of the vast majority of people trying to make this work. If you made it all the way to this point, you're clearly different from most. You invested your time and attention into understanding something that goes completely against conventional thinking about trading. That tells me you're serious about this transformation, and that's exactly the mindset that leads to real change in your results. So here's what I'd appreciate. If this perspective resonated with you, if something clicked during this conversation, hit that like button. It genuinely helps this reach more people who need to hear it, and it lets me know this kind of content is connecting with you. And if you haven't already, subscribe to the channel, because everything I share here is designed to cut through the noise and give you the principles that actually work. Not hype, not shortcuts, just the reality of what separates those who consistently profit from everyone else. Leave me a comment right now saying "Patience over impulse," so I know you were here and this message landed. I read every single one. There's a video right here that goes even deeper into reading wave structures and identifying the exact moments when pullbacks complete. It complements everything we just talked about perfectly. Click it and continue with me over there. I'll see you in the next one.